finish up that one piece that you had there?
Yes. What a thesis is, what your thesis is. So basically who you are and what you represent.
Okay,
within
great.
a professional context.
Sure. So I'm one of three partners with Amberstone. It's a $45 million venture fund focused on consumer branded products. I would say that there are a lot of different theses that are thrown around, whether that be focus on e-com, D2C businesses, whether that be a focus on maybe different communities that are being built or platforms around those communities that are being built. For us in particular, our thesis is around strictly consumer branded products, particularly products that have velocity associated with them. So really brands where you can interact as a consumer at least once a quarter, but hopefully more like once a month, once a week, once a day type of consumption patterns within beauty, personal care, pet, baby, food, beverage, and household goods. For us, we participate really in the Series A is how we define it. Obviously, those terms are changing daily, but for us, we define that really as writing checks anywhere from 3 to 8 million is our kind of core sweet spot. In brands that really are sub, call it 20 million and trailing 12 months revenue, and that are at these inflection points where maybe you're going from natural to conventional, natural to more naturally oriented conventional, conventional to mass, trying to build out a D2C business into natural. Those types of movements are really kind of where we have planted our flag and where we get really most excited about working with brands along their journey, in a pretty wild world of consumer these days.
And when you said you're a 45, is that a captive fund? Is that still a independent sponsor? How are you guys? And explain the difference for anybody who doesn't know.
Sure. So there's a lot of different ways in which funding can work. We're what's known as a blind pool of capital, where different entities, call it individuals, high net worth individuals, angel groups, endowments like the call it Columbia University endowment. They're not in our fund, but that's a good example. Give us capital to then deploy at our discretion. They don't have a say they believe in the thesis and they believe in the team, but they don't have a say in each individual investment. There are a number of fundless sponsors or kind of called search funds where they will go out, find a deal, do the diligence, get an allocation in that deal, maybe $1 million, $2 million out of a $5 million deal. And then they'll go and pass the hat around to various groups or individuals to help fund that deal. And then there's some of your angel groups that, are just organizations of high net worth individuals within a community that can help fund different deals as they come across their desk as well. So multiple different ways of getting funding. Our 45 million is in a blind pool where the partnership has full discretion over how to deploy that capital. And then we've deployed it in 2 deals thus far. The first is Honey Mama's, a refrigerated cocoa truffle bar based out of Portland, Oregon, mostly in natural right now and making a concerted effort to get into conventional. And then the second deal that we did is in Juneshine, a hard kombucha brand based out of San Diego. So hopefully deals 3, 4, and 5 will be closing before February, and we'll just kind of continue rolling.
On the fundless sponsor, blind pool, and angel groups, rip through kind of as a founder's perspective, pros, cons of each one of those, because they each have them.
Yeah. I'll start with ours because it's probably the easiest. You know who you're dealing with right off the bat. You're dealing with 1, maybe 2 of the partners. You probably get to meet the entire fund. You know that there's not going to be a lot of cooks in the kitchen, so to speak, with that capital that's coming through. And there's really the buck stops with our fund, so to speak. I would say the cons though too we're, for lack of a better term, we're institutional. We are going to look deeper into your organization than most. We are going to try and uncover hopefully no skeletons, but certainly are going to dig into every aspect of your business, how your revenue is built, what doors are performing, what doors are underperforming, what your D2C business looks like, how is your repeat purchase behavior, what does your subscription look like if you have subscription, how are your cohorts holding up on a 12, 18, and 24-month basis, how much are you selling on promo on that first deal, are you trying to get people in at a loss, or are you positive on first sale? These are all questions that we're going to ask that sometimes can be really painful for groups to go through, and we apologize for that. So we're pretty upfront with our diligence process. Whereas maybe angel groups, maybe some high net worth individuals, they're not going to dig in as deep. They might just be like, hey, you know what? This is a brand I really enjoy on a daily basis. I have you in my refrigerator, and it would just be so cool to be able to invest in something like you because I believe in you as a team and I'm a huge fan as a consumer. So let's just see where this can go. So that's probably kind of one of the pros of working with maybe an angel group or high net worth individuals is they might not dig in as much. They might just kind of let you run a little bit further or have a little bit more leash, so to speak, from a diligence perspective. The downsides though is that they're, let's say it's a high net worth individual and they're CEO of a biotech fund or biotech group out of San Diego. That seems pretty appropriate down here. They're not going to spend their days in CPG. They don't understand it. They don't have the network in it. They're not going to be huge value adds for you. Whereas an institutional fund like ours that spends every single waking hour of every single day within consumer branded products is going to help you find that VP of sales. We're going to help you get plugged into the right broker network that handles natural, or we're going to find the right broker network for Target or Costco for you to bring on board and to onboard into your organization. So, there's trade-offs with each organization that you're going to have to weigh. And I would also say that there's timing with each organization where a high net worth individual or an angel group might be more appropriate at the seed stage. They might be willing to participate in a convertible note or a safe note or a structure that is more favorable to the founder to push a valuation event down the road and to give you runway to build into a company where a group like ours can then take a look. You'll have the sophistication for us to run a full diligence process, and we can run more of a price round at that point. So there's different communities and different investors available to you as founders at different stages of your life as a company.
So you've clarified the blind pool, you've clarified angels, you haven't talked about fundless sponsors. How do you even identify a fundless sponsor? Because they seem to present as actual funds.
Yeah, that's a good question. Most of the time, we're doing our diligence on you. You should be doing your diligence on us. And that's going to involve.
Perfect segue.
I would say, for us, we're very transparent. We have not only every company that's in our fund, but every company that we've worked with on a pre-fund basis on our website. Call them, be like, hey, tell us about Amberstone. Do they have capital? Because 99 times out of 100, they're going to be able to say, yeah, they absolutely have capital. And by the way, when we needed to do a series A2 to support our Whole Foods launch, which was completely unexpected, they funded in 5 days. Those types of questions, the speed of funding, I think can help give it away. A lot of fundless sponsors can't move with the speed to close that we can move with, or that other institutional funds that have committed capital behind them can move. I think more often than not, they're less transparent with the investments that they've done, mostly because they probably haven't done very many investments. Or if they have, they've been more on individual basis and they're trying to build a fundless sponsor as this next iteration of what they can be, maybe taking their smaller track record as angel investors and putting it into a fundless sponsor to try and start building a fund that way. So I would say, more than anything, do your diligence on us. make your phone calls, do those back channel checks. Don't be afraid of it. Like you should absolutely be asking questions on, who's getting into a relationship with you. These are, long-term marriages, 5, 6, 7, 8 years at times, where you're going to see us. I mean, the Honey Mamas team, I see in person at least 6 times a year, including some trade shows where I see them at. I text with the CEO on a daily basis. I text with the CFO on a daily basis. I'm talking to the marketing team every week or so. Like these are long-term, very in-depth relationships, and that's how you should treat them, like very kind of respectfully and definitely doing your background checks.
So institutional fund managers typically are working a lot with their, with their portfolio companies, as you just indicated. The question, I guess, for a founder would be, if you're spending 80% of your time managing your current portfolio, which I'm just taking a wild guess is maybe where it lands, that 20% of the time, what is the best pitch you've seen, without saying a name, that's got your attention, that got to the front of the list? Like, how's the best way to approach a VC, given that limited amount of time is for new diligence or new deal flow?
I think it all comes down to each fund. I mean, you have to understand the fund. And that's tougher. It's a lot easier to say than it actually is to execute. I feel like we're very transparent on our website. You're going to understand that we look at margin, we look at velocity, we look at capital efficiency, we look at a certain size of company. And I think if you can understand that and put together a pitch that just says, hey, we're a $5 million brand that has 45% gross margins in the food space. We've only raised $300,000 in a friends and family round 3 years ago to get here. And we're getting ready, or we're the top performer at Whole Foods in our category. And we're getting ready to now activate Publix, H-E-B, Wegmans, and some Kroger banners. And we need capital to support that. Like, that's going to get my attention pretty quickly. It's just, are you checking the boxes that we're looking for, that we lay out pretty clearly on our website? And can you do it in a succinct manner that, and I will say this, like, unfortunately, like, it can't look like a PowerPoint that a 5th grader put together. Also, like, you could have the greatest company in the world, but you have to have some polish as well. And it's like, it's so, I don't know, so like short-sighted to say that, but there is something to it. I mean, I've looked at roughly 850 companies last year. I would say on average, I will read through every deck, and that will take me 10 to 15 minutes to read through every deck that I receive. But I can tell you the decks that have a little bit more polish, a little bit more thoughtfulness around them, and are thoughtful not only in addressing what we look at, but also being thoughtful about their company. If you're a $1 million revenue brand and you're trying to raise 5 million at today's kind of valuations, like, I'm going to question that. I'm going to say, listen, if I give you the right valuation that we would be comfortable giving, call it 3 to 5 times revenue, and you're trying to raise 5 million. So now I'm going to give you a $5 million valuation. You're going to raise 5 million on top of that on a post-money basis at 10 million. I'm going to own 50% of your company. That's not the math that's going to work right away. Like, we aren't ownership oriented. We want to make sure that you kind of maintain your most valuable commodity, your most valuable form of currency, which is your equity over time. And if you're kind of getting into a round early in your life where you're giving away the house, that doesn't benefit anybody. That doesn't benefit us. It starts a very poor relationship if we're taking 30, 40, 50% of your company. And it disincentivizes you as a founder to continue to work the same way that you have been working, because you're probably going to go through another round of funding after that. That's going to be another 20, 25% dilution. And now you're looking at a company where you had maybe 80% of the brand before you went through these funding rounds, to a company now where you have 10 or 15%. And that just isn't how we view the world.
So
there might be some
right sizing the deal.
right sizing the deal for sure. So just, I would say overall, just being thoughtful about how you approach the situation, showing an understanding of how kind of the simple valuation math would work at a very high level, even just kind of like back in the napkin type of things. And having a little polish to what you put forward, I think gives you a leg up. Now I might be weird. I read everything. Like there are
No,
funds that might just like look at something and be like, nah, like we're not going to look at this. Like I will read everything that comes in front of me. But that might not be everybody.
I ran a fund a while ago, and it was kind of, I'd get a kind of a pretty rudimentary chump-o-matic pitch deck in a highly branded consumer goods space. And it was one of those things like, well, you can't brand yourself. The confidence level of you branding your product in a crowded market space, pitch decks are also crowded. So it's just like, I get it. There's like a weird kind of undertone to, if you can't brand yourself and polish yourself, then you're going into a competitive field that's incredibly sophisticated when it comes to branding and polish. Switching gears a little bit, and we can do this two ways. You get to choose. Would love to hear, I'm a big fan of contraindicators. There's a lot of things like, oh, we look for all these great velocity and great sales. Like, of course, everyone's looking for that, right? Like, you got a product that moves, it moves fast, people buy it frequently, and you're opening new doors. Like, that is almost a no-brainer investment. Give us some of the reasons why you passed on deals. And you can do this in the two ways. Is one, just kind of a hodgepodge without naming names, or you can tell everybody why you passed on Pass the Honey numerous times. And I will field those. I was hoping for that reaction. That was my whole, I was waiting to throw that out.
Number one, Pass the Honey was presented to me when I was with a previous fund that was a fundless sponsor, and we didn't have the capital to support you. And things were falling apart there, and I was joining Amberstone. So I deserve a break on that one, Doug. In terms,
you don't even have to do this. It's totally fine.
No, I mean, in terms of why we normally pass on deals, and like, I will say the venture community is incredibly opaque and it's broken. Like, it is a huge problem that I have, is there's no clarity for the most part to why people pass. Hey, like, thanks for taking the time. It just isn't an opportunity for us. That doesn't help anybody. Like, so specifically, like when we pass on a deal, we are going to pass because there are multiple reasons that we have established as first principles that we're going to pass on. I would say the first is going to be gross margin. Like, if you are not above a 30% gross margin, inclusive of freight, which a lot of funds don't include, but we do, we're not going to be able to look at you. We're going to be like, and I will tell you that.
Do you include marketing in that though?
No,
a lot of these brands are building. Got it.
Yeah, no marketing. Marketing is an SG&A. I will include any promotional and discount as to get from gross to net, but below net revenue, it's going to be your normal COGS inclusive of freight out. Many of these brands are D2C brands or have a D2C component to them. Part of selling your product is sending your product to your consumer. Like, that is, I guess, fundamentally how we view it. And so it needs to be part of the cost of producing and selling your product. Hence why it's in margin for us. But that was my way of saying, like, it'll be a very clear pass. We'll be like, hey, you're at a 24% fully loaded gross margin. It's not going to be an opportunity for us if you can pull it. But that gives you an action item. That gives you as a founder the opportunity to be like, okay, cool. I'm going to focus on my margin right now. And I'm going to go talk to Amberstone when we're at a 33% fully loaded margin, because it helped fix our commodity input costs. It helped us focus on our 3PL provider to get better shipping rates. It helped whatever it helped with. Like, that is an actionable item that we can give very good feedback to founders. So that's probably number one. Number two is velocity. I mean, if you are not a top decile brand in terms of how quickly you're turning, and whether that's on the physical shelf through spins or IRI, or the digital shelf as measured through, most likely Shopify data. And we have kind of a database that we've built out where we can comp you against multiple different brands in multiple different categories. We're going to pass. I mean, if you are just a product where, the consumer isn't necessarily coming back to repurchase your product very often, that's not a very good signal for us.
What's a good recurring customer rate? D2C, just pick one channel.
I mean, God, it all depends. Beverage is a nightmare to do D2C. And beauty is beautiful to do D2C. So I would say, if you can maintain somewhere north of like, I mean, roughly across all categories, I'd say like 15 to 20% would be a good place to aim for.
And let's do food in retail. What's a good velocity per store per week?
Again, depends on the category. Hot sauce, if you can move 2 units per store per SKU per week, you're going to be great. If you're in salty snacks, you're probably going to be wanting to move at minimum low double digits. I mean, you're not going to move triple digits on a units per store per SKU per week. Like that would be awesome. But I would say, if you're in the low teens on salty snacks, like you're going to be pretty solid. But again, that comparison, we have access to spins. We're going to look at how your product is performing on the shelf. And that also gets back to our diligence. Like, I would never tell a fund one thing when that fund probably has the resources to verify anything that you say. So that would be one little tip of advice. We've seen that before where groups have said something, they've gotten us really excited and we've gone to verify it. And it's the data does not support the story. So I would be very open with the funds from the very start. We oftentimes have resources to dig in, and I would say finally for us, a couple more things for us. I would say capital efficiency. We define it as your last 12 months of revenue divided by your total capital raised in the lifetime of your company. And we need that to be a 1-to-1 ratio for us to take a look at your company.
Is that a unique metric? Because you were the first one that mentioned that to me.
Capital efficiency is not a unique metric.
No.
The way we define
how you measure it.
The way we define it is unique in our conservatism around it. We are very kind of, it's a sacrosanct measure to us. And we believe that 1-to-1 ratio basically says for every dollar that you're bringing in, there needs to be $1 to the top line. And I think, some people think like, well, let's just do it on a lifetime basis. And that just doesn't necessarily make sense. And we don't think it's reflective of the most recent performance of the company. And so, to us, that 1-to-1 ratio of LTM is definitely more conservative than most. But I will take a step back here and also say, like, we're only putting 6 to 8 companies in our portfolio, whereas other funds that are 45 million might put 20 or 25 companies in their portfolio. We just take a different approach. We believe in a more concentrated approach to portfolio construction, and that if we're going to do our diligence and we're going to get to know these brands and we're going to get to the point where we want to make an investment, let's make an investment. Let's actually put our money where our work is, and let's support these companies in a big way, and let's support them through multiple rounds of financing. And so, for us, I think we take a more conservative approach because that helps us build a stronger portfolio of companies where we really can't afford to miss. Like, we can't afford a company to go to zero or return our investment. Like, we need each brand that we take a leap with to return a good multiple of invested capital for us.
Got it. Was there one more kind of guardrail contraindicator?
I was gonna say team. If the CEO's leaving or needs to be replaced, we're not going to invest. We're taking a risk alongside the team, and we need to believe in the team.
You see early stage food companies, food and beverage companies doing sub 20 where they're out fundraising, the CEOs has a foot out the door, that people are actually trying to fundraise with that?
I'm sorry, one more time.
You said that if a CEO is on his way out, so you're seeing sub $20 million brands that are growing, raising capital with the CEO that has one foot in the door and out the door?
I've seen a handful where the CEO wants to step into more of a chief development officer role, where they're very creative, they're very good at creating product, and they've created a very good product, and now no longer really want to run the business.
So you want operators?
We want operators.
Okay.
And again, like, we're very particular. We have to be, though. Like, I would say there are a lot of funds that might be okay with that. There are a lot of funds that might help support that transition. They might bring in an interim president that can run the brand, but the dislocation associated with that switch, I mean, you're going to lose at least 6 months, if not more, of having a fully committed leader at the top of the organization. And that's 6 to 8 months. That's a full reset period. That is, that is trying to do a sales cycle at Kroger and losing it because you don't have your leadership in position. And now you've just lost a $2 million account. And so for us, like, that's just not something we're going to get involved with. So those are our 4 points that we really will drill everything down to. And that's the lens we look at everything through.
Thank you. Can you see the thread, the messages?
I'm clicking them up right now. So did you just want me to run down and say?
Yeah, go for it.
Yeah, grab each one. Do you find a common line item in COGS that CPG companies at an early stage do not manage well? Yes. Well, it's both in COGS, but I will also kind of bring it up a level into that gross to net spread. I would say a lot of early stage CPG brands don't necessarily have a sense of what their promo strategy should be. And that oftentimes the category will be, let's just take, what was I just looking at? I was looking at an oat milk product, and the category is 15% roughly of promo spend. And this brand was at 6%. Like, you could definitely afford to go higher. There are other times where I'm looking at a category and let's say it's 15% again, like for example, and they're spending 35%, but they don't necessarily measure what the pre and post promo lift looks like. And that they don't realize that at 35%, they're actually not getting any return. They could be at 16, 17, 18% and get the same amount of post promo lift that they would be getting at that 35%. And again, that just comes with capital, that comes with a little bit more maturity as a brand. And I think it certainly can help to get an investor in there that understands the space. So that would be one within the gross to net spread. And then I would say, I mean, everybody's failing to manage this well, but it is your freight. Like, freight's a nightmare right now for everybody. So I feel the pain, but I would say the more understanding you have around freight and the more you build in buffers to the nightmare that is freight today, the better your business will be suited for kind of long-term, the better suited you will be to handle the kind of the ups and downs associated with freight today. So those would be kind of the line items that definitely stuck out lately. Scott, the variables in the capital efficiency formula. So it's your last 12 months of revenue. So from December 25th to January 25th, if we were to look at it today, divided by your total capital raised to date. So if you've done $5 million in revenue over the last 12 months and you've raised 1 million in total, maybe between a $300,000 friends and family round and a $700,000 convertible note that you put in place, you are at a 5-to-1 ratio. That is outstanding. We would be super, super excited by that. There are some nuances in there. Like, if you've raised $1 million and you still have 300,000 on the balance sheet, we're going to remove that from the equation and give you credit for that 300,000. So it'll be more like 5 million in revenue divided by 700,000. So your ratio will actually be better because you've been able to conserve cash on the balance sheet. And then just getting back to Jack's question here, are you saying a $10 million investment must equal $10 million in gross revenue? So Jack, I'm saying eventually it will need, if we put 10 million into a brand, we expect that before that next round of capital is raised, they are back to a 1-to-1 ratio.
Gotcha.
We look at it pre and post then.
What's that?
You have a look going in and a look coming out as well.
Yeah, I mean, for a brand doing 5 million in revenue, if we give them a $5 million round, like there's a chance that they're not going to be at that 1-to-1 ratio. Let's say, or $4 million in revenue, and we give them 5 million, like for a couple months, they're not going to be at 1-to-1. Like that's fine.
Yeah.
But we expect that our capital is going towards sales related activity. You're building top line while maintaining a strong margin, and you will eventually kind of move back into that 1-to-1 ratio.
Back to kind of, and again, I don't know who's on the call, but founder perspective, best way to cold email a VC. Is it just quick bullets, highlights? Is it paragraphs upon paragraphs and attachments and videos? Is it a cold deck? Like what is the one way that can get, kind of your attention real quick outside of what you said were your criteria?
Yeah, I mean, I would say the best way is not to cold email. If you can find a warm introduction.
Wasn't the question, Nick?
I know it wasn't. I'm just trying to be honest here. If you are going to cold email me, I'm going to give a contraindicator, and I get this so often. Like, don't tell me that your company is the next greatest thing in, like, you are going to own the $4 billion category of whatever you're going because you have this unbelievable IP of a unique way of making a pretzel. Like, you don't. And I'm not gonna read that. Like, it doesn't demonstrate a real understanding of the category that you're in. I appreciate the excitement and the enthusiasm and confidence, but they're all slightly misplaced at that point. So if you're going to reach out to me cold, I would attach a deck. I would put some high level bullets around just revenue, margin, and what the raise looks like. Hey, we need 3 million to do X, Y, or Z. And then I would say, I'm available, give me some times. Say, like, I know you're busy, but here's some times that I have available next week. Let me know if you have some time to connect, and I'd be happy to put 30 minutes on the calendar. Like, if you can give me that that I can read in 45 seconds and download a deck to review later, like, I'll probably give you the time of day. Like, I probably will be like, okay, like, you're going up on my whiteboard that lives next to my desk. I'm going to remember to revisit you when I take my 2-hour block to review decks every day. And I'm going to make sure that we find time to connect. And I give you the respect that you deserve for taking that risk and that leap to cold email a complete stranger. Like, it's intimidating. It sucks. Like, I've done it. Like, I remember looking for jobs when I was graduating college in 2008, and I cold emailed. Like, it sucks. Capital raising sucks. Like, that's the approach we always take. Like, it is terrible. So if we can make this process a little bit more transparent, a little bit easier, then we're going to try and do that.
Dig it. Bob had a really good question around capital raising and CapEx. And I'll even back that up. What is your expected use of funds? What are, like, no areas for your capital?
I mean, no areas are, brands that are going to start a multi-unit coffee chain after being a successful RTD coffee brand. Like, I would say CapEx is nuanced. If you're going to build out, 30 new cafes with the capital that we're giving you, like, we're not going to invest in you. That's a completely different business. We're not investing in a multi-unit concept. We're investing in a CPG brand. Now, CapEx, I personally, and I think we as a fund are comfortable supporting it in certain instances. Namely, co-packers sometimes are going to ask you to purchase specific equipment to put onto the line. That's a necessary piece of CapEx to drive your business going forward. 100% going to support that. Juneshine, they found the Ballast Point brewery that was being sold for pennies on the dollar. They could produce 120,000 cases out of that facility. Totally makes sense. Like, we would support that all the time. Now, there's some instances where CapEx just isn't necessary. Like, if you are owning your own production and you are doing, call it sub 10 million in revenue, do you really need to go buy a $500,000 cartoner at the end of the day to remove maybe 2 or 3 employees at the end of the line that are boxing your product as it comes off? Like, probably not. If you can show me that the margin that you would gain from that cartoner is accretive, and by getting rid of those 3 employees, you have a more efficient, better business, like, I'm all ears. So I guess what it comes down to is CapEx is slightly frowned upon. It's not necessarily what we hope our capital goes towards. We want our capital, to answer your question, Doug, to go towards sales building type of endeavors, whether that's, potentially hiring a, sales director for West Coast and sales director for East Coast, whether that is making sure that your free fills and slotting fees are covered as you enter into new doors. Those are necessary. They drive sales. Is it going around R&D? Is it going around some new hires that are going to help your business be more efficient? Is it going towards marketing spend in areas where there's a very high positive ROAS? Like, those are areas that we hope our capital goes towards. If it goes towards CapEx, that's necessary to build your business and continue to help it scale. Like, we're all ears. We're open to making that argument. We're going to have that discussion with you, and we'll most likely support that spend of capital, most likely. But we want to see you make the pitch to us. Why is that $500,000 piece of equipment necessary? So that's kind of my answer on CapEx. All right, Stacy, what role?
Customer sentiment.
Yeah, wow. I mean, this one is like the black box and unbelievably hard to measure. We actually have invested in almost every diligence process we've done a company called Social Standards that will look at every social conversation across multiple different platforms in the United States to help identify not only where your product or your brand is being discussed, but the intensity with which it is being discussed versus not only other brands in the space, but also adjacent categories, as well as lifestyle indicators. And by that, I mean, when people discuss Juneshine, 90% of the people that discuss Juneshine are also discussing yoga. They're discussing skateboarding. Oddly enough, they're discussing Comic-Con, which was a really weird one for us to find. Our guess is because Comic-Con's in San Diego and Juneshine's a San Diego brand, they happen to overlap. But that is one way in which we, again, like getting back to my other point, the resources that we have at our disposal, we will use that to really help push our understanding of how your brand is discussed in a social context versus other brands geographically, across demographics, across and versus other lifestyle indicators. So yeah, social standards. Thanks, Doug. I would also say there's like social nature, I think, is one we can look at. And then Social Blade is another resource that we use to basically, like, I can't answer that question like right off the bat, but I can triangulate in on that answer to be confident in what my sentiment is around your brand. So I don't know if that totally makes sense, but those are the tools we use to kind of like circle the wagon, so to speak.
I just put the Social Blade link in there as well.
Yeah. All right, Jaya, are you particular about what category you invest in? Refrigerated, shelf stable, frozen, et cetera? Nope. We will look at anything and everything. I'm in a refrigerated chocolate bar right now. Juneshine was refrigerated before they became shelf stable, which opened up a huge market for them. I would say, while we are not particular about category, there are certain categories we like more than others. I think cake mixes and frosting is tough because how often are you purchasing a cake mix? Your velocity is maybe 1.5 times per month. Same with kind of hot sauces, condiments, etc. Like condiments have really been done, and they don't move very much. So for us, velocity is very important. That isn't to say that you can come out with. I mean, I think some of the brands that stand out in slower categories that I would have loved to have supported, somebody like a Maya Kamal. Like Maya Kamal is an outstanding brand with huge extendability into other different areas. And they happen to be kind of in shelf stable sauces when they first launched. Like I would have loved to have supported that brand. I bet you within shelf stable sauces, their velocity was outstanding. Frozen scares me a little bit. You only have one aisle in the supermarket, and it's probably the most expensive aisle to play in. So I would say the hurdle is even higher in frozen. Whereas, throw me a salty snack brand that's performing, and I will definitely take a look any day of the week. So it's kind of category dependent. Long-winded answer for a very kind of short question there.
Helps. Thank you.
Are there any founders on this that want to know specifically kind of the metrics that Nick uses as guardrails for their specific category instead of being generalized? Just get very like, there you go.
Were you asking me? Are there founders that use?
No. Jaya and whoever else on this call, like, hey, I want to know, hey, Nick, how fast does honeycomb move?
I don't know how fast honeycomb moves. You're making a new category here. There's literally only one other competitor in your space. I'll go to Spins and I'll find out.
Oh, I would love that, by the way, because I think it's $800 a year.
I could tell you what dollar per TDP for chocolate bars is for the top 5 performing chocolate bars. I could tell you what IRI data says about June Shine, but yeah, I mean, each I don't know. I there's not a chance I know every category off the top of my head. I know like 3 categories off the top of my head, but I can go back and I can look at the data when I need to. That's a bad use of my brain space, Doug. I don't have very much. My wife will tell you I don't have a ton of space left in there. So
you got a new baby too.
Oh, seriously, it's real. That's real baby brain.
I'm good. I don't know, Kirsten or anyone else, if there's other outstanding questions or curiosities into the VC world.
I'm going to do everybody a quick favor here over in the chat. That's my email address. If anything pops up, you have any questions or just we're kind of too shy to ask on our big group call here, like feel free to shoot me a note. I usually spend a couple hours every afternoon kind of combing through emails and getting back to people. So happy to be a resource, happy to grab coffee with anybody in San Diego that just wants to chat and talk about their business or anything else that's going on. I just moved down here in November of COVID and had a baby. So I actually haven't been very social. So the more I can get out, the better. Stacy, in terms of plant-based, no, I would say it's not cooling off. What is cooling off is plant-based with horrible ingredient decks. So I think the shine is off on Impossible because when you actually look at it, it's pretty terrible for you, like really bad. But plant-based in general, no, absolutely not. It is still going. I would just say kind of just like the non-plant-based world, the cleaner your ingredient deck, sugar is public enemy number 1. Hydrogenated oils remain terrible. Those types of ingredients that, even Oatly. Like Oatly is I think 11 or 12 ingredients, and the company we're looking at is 4, and it's a significantly better product. Like those types of brands are going to be what wins, in our humble opinion. But no, I think plant-based continues to grow. Stacy, lean into it, get after it. Oh, come on, Jack. What is the next hottest trend I see taking off?
What are you excited about right now? I mean, where if you're putting your money out there, where are you trying to get ahead of?
We've talked about this a lot as a fund. We're not cool. Like none of us are cool people. We're all kind of nerds and dweebs at the fund. Like we're not trendy. Like that's my, like, honestly, like we're not trendy. We don't know what a trend tomorrow could be, but we do know, and we've spent 50 years combined identifying companies that have long-term potential to succeed based on the metrics that we've put together and the muscle memory that we have. So we're not going to invest our time or effort into identifying the next big trend. We're going to continue to invest our time and effort into finding great companies within those trends. If that's, so yeah, I started off, we're not cool. We never will be. So we're just going to accept it and work with great companies. If I were to try and think of something like, I mean, adaptogens are going to continue to grow. I think a departure from caffeine in one way, shape, or form is super interesting. So I think Mudwater, Dose, Clever, probably the three. I think like Four Sigmatic kind of lost its way a little bit. So I think that continues. One area that just has me super excited personally is regenerative. I think it's better defined than organic. It actually has a much better environmental impact than organic, and is a tool that we can use not only to eat better as humanity, but to restore topsoil, sequester carbon, and actually use it as a tool to fight climate change. So for me, like multiple benefits, and I think it's about 10 years behind organic right now. So super excited about what's going on within regenerative. So Sydney, I'll jump back into you. Do you prefer to invest in stale categories needing innovation or rapidly growing categories? I mean, chocolate grows at anywhere between 5 to 8% a year. So I wouldn't say that that's like the most exciting category. And we invested in a brand within there. June Shine is growing, the category grows 100% year over year, and we invested in a brand there. So I would say, again, like it's not necessarily a category per se for us. It is your brand performing within that category in a way that stands out to us is how we look at things. Answer, Doug.
Question on the Honey Mamas. Oh, now I can ask whatever I want because I didn't start. I didn't finish my question. On the Honey Mamas thing, placement in the cooler. You talk about having chocolate kind of having these slow growth. If you're in the chocolate aisle, how much does placement come into your considerations, or is it an output of the metrics is an output of placement?
No, placement beats us up.
Perfect Bar and throw it in the same.
Placement beats us up. Like Perfect Bar was the locomotive that had to go uphill and pull everybody into refrigerated. We're lucky enough to follow behind them. But I would say that the refrigerated bar category, there's 5 bars. There's Perfect, there's Milk, there's Us, there's Hail Mary. Yeah. And there's Boo. Boo has some refrigerators. So Boo Keto or Boo Foods now out of San Diego also has done a good job there, but 5-6 bars. And Sprouts, there are 82 shelf-stable bars. Like the category is just so significantly different, and it's not where the consumer is used to finding us yet. So I think our velocities are significantly lower than they will be in 2 years. So that's the answer there. Minimum annual revenue for your portfolio companies to feel confident for strategic exit, from Bob. I mean, Bob, like our goal is to give you probably 18 months of runway with the capital that we provide. We think that there are multiple different exit avenues from there, whether that be, we're kind of like the little brother to the big brothers of VMG, ACG, TSG, Catterton, Kavu, maybe. These brands or these funds that started as $100 million funds were very successful and moved into 300, 400, 500, I guess. And I mean, Catterton's about 1.5 billion these days. TSG is 4 billion. Like they just moved into a different world than we are, but they can write. I think if you're putting it a different way, if you can get to 15 million in revenue, you've opened yourself up now to a 20, 25, $30 million check from VMG, and they can help take you to that 50, 60, 70 million, which I think is where a strategic exit starts to become very viable. there's also something to say. I mean, we've invested in brands that have scaled quickly enough that they hit that 35, 40, 50 million. And then it's a question mark. Then it becomes, okay, well, we're at 45, but we've scaled to 45 million because we're creating a new category and there's significant strategic interest already. Like, what do we do? Those are the fun questions. Those are, do we leave enough meat on the bone for a strategic acquirer to then take it, put it in their distribution network and drive an additional 150 million in revenue out of it? Like, or do we continue to scale, chip away and leave less meat on the bone, but now we have a higher revenue, which is going to lead to a higher valuation? Like, those are the interesting questions to ask. And those are the fun conversations we get to have at the board level, quarterly, if not monthly. So yeah, I would say 15 is the minimum to start to feel confident for a true growth equity round of that 25 million plus. And I would say 40 starts to get you in the conversation for strategic exit.
On the exits, Nick, this is a philosophical question. It's something I struggled with when I had a fund, and I think this is, and we're starting to see the consolidation in the food supply, not only affecting nutritional value of the food we eat, but also from a supply chain perspective, which is becoming very apparent right now. The role that venture and private equity plays in exiting to larger conglomerates or strategics and participating in that kind of further consolidation. Does that ever, have any consideration in your investments? Or is there a way to invest for, a Chobani of the world or a Patagonia that don't have intentions to sell immediately?
It's a great question, Doug. And I'm not going to give a good answer here. Like, at the end of the day, we're beholden to our LPs. We've made a promise to them to return capital. And the way in which we can return capital these days is almost exclusively through strategic exits. Do I think what Hugh & Co is doing with their SPAC is super interesting, and that they're the right leadership team to potentially bring a portfolio of companies together that never has to exit, that can do good for the world? Like, absolutely. Do I also see the opportunity to continue to have executive teams act independently of larger conglomerates? Like, you're seeing that happening a little bit more often these days, where maybe the RX bar founders came in and just were totally turned off by what Kellogg did. And I think Kellogg's learning a lesson that there is an ethos, there's a personality to the funds that, or to the groups that they are acquiring, and that by removing leadership or trying to change too much within those groups, they risk destroying the ethos that made those companies special. And I think more and more they're trying to give them a little bit more hands off. Like, here's access to everything that a Kellogg or General Mills or a Nestle can present, but we're actually going to be hands off in, how we ask you to run. So my hope.
Are there any examples that have been? I mean, I have one in mind, but any other examples of kind of autonomously run executive leadership after an acquisition?
I mean, Yasso, I would say, has been pretty good, giving them the leash to move their company out to Boulder, to continue the innovation that they've had and the production that they've had. Kettle and Fire. I'm trying to think of anybody else. I mean, I don't know. I could think of a few, but I mean, what you got off the top of your head?
Yeah. Justin's was kind of one of the original ones that I always think about, but I don't know what's going on internally there now. But and that was ConAgra, right? Or no, was it Hormel, which I would not have expected would have given any autonomy. I would have expected they were a machine. They would just act like a cog.
And I mean, cool. To an extent, like, you can influence that as a founder as well. Like, if you put in it one way, if you're building a company that is prepared for strategic exit, you're probably going to have multiple strategic suitors at the table. If you're a food brand, you're probably going to have 3 or 4 different food conglomerates looking at you. This is, again, your opportunity to work with your investment banker, your fund, whoever's helping you on this process, to identify the right partner and put in place those protections for you as a brand to make sure that you try and live on in perpetuity, so to speak, as a brand.
Yeah.
So
I think we're out of time, Kirsten, or close to it.
Well, thank you, Nick. That was so great. I mean, I learned a ton, and I know there's a good number of founders on the call as well. So I hope they for sure took some good nuggets away. So thank you, Nick.
yeah, you're welcome. It was my pleasure. It's a total joy, and I get to, spout off about our unique way of looking at the world. But like I said, if there are any questions, anybody wants to chat more, like please feel free to email me. I'm a fairly nice person, so I promise I'll be I'll play nice.
Nick,
Well,
thank you very
Nick.
much. Appreciate it.
We'll
Let's
be in
grab a
touch.
coffee.
Yeah, Doug, definitely. We'll catch up again.
Talk to you soon. See you
Have a
all.
great one, everybody.
Bye, guys.
Bye.